This is the second edition of our podcast, and we're here this morning with Steve McKay from Personal Mortgage Group and familiar face Josh Purdon. I guess it's our podcast now.
I guess it is our podcast,
which sucks.
That's going to require some rebranding.
Yeah, exactly. All right, perfect. What was it called initially? Baywatch. Okay. We're here this morning, and the topic today is a bit of a carryover from our last podcast, where we talked about kind of the roles of the realtor and the lawyer, the interplay between the two, how the realtor sort of builds the file from really meeting the client to getting the agreement of purchase and sale signed. Transfers that over to the lawyer, and what kind of work we do with that file once we get it in order to get the deal closed. And in the process, we thought it might be a good idea to really look at one specific file and drill down on that file, one that's got a few quirks that kind of didn't proceed in the ordinary course. And what we thought we'd do is actually put together the team, the mortgage broker, realtor, and lawyer that actually took care of that file. And so this presented an interesting opportunity because we've known each other for a very long time. We all went to high school together, and so we worked on a file for a client that also was a common mutual friend of ours. And so we had this opportunity to sit down and dissect the file and look at how it began, how it developed, the hurdles that were encountered, and then ultimately how we closed it up. And the other interesting piece about the file is that it dealt with a couple that was looking to buy an investment property, which is also something that is very much on a lot of people's radar today. And so what we thought we'd do is apply the same methodology, kind of look at the file from inception to its end, and work through our respective roles, how they kind of complemented one another. And high level, what this really is meant to convey is a point that I like to make quite often, and that's there is a real value produced by having a realtor, a mortgage broker, and a lawyer that work together on a file. And so once that sort of team is put together, we're able to stick handle anything that comes our way. And so this is this is just the best example of that. So Steve, would you like to just give us a quick rundown, quick intro, talk to us about Personal Mortgage Group and how long you've been at it?
Sure. So Personal Mortgage Group's been around forever, 1991, sort of the original mortgage brokerage in Hamilton. Not the first one, but one of maybe 3 or 4, because there wasn't really a mortgage broker channel until the 90s. And I started in 2011. And so I've been doing it for 12 years, mostly specializing in sort of self-employment, lots of rental portfolio stuff, that kind of thing. That's how I ended up doing this file, or getting called for this file. And then we're just kind of like, high customer service, low rate type of brokerage. We only do pretty much AAA clients, people who want good mortgages, good property.
Sure.
That kind of thing. And that's all I have to say.
Wonderful. Thanks. Josh, give us the intro.
Yeah, sure. So Josh Purdon here from Remax Escarpment. So we had, as Santi was saying, we kind of had the idea to dive into a particular file as a bit of a case study. The previous podcast we did was generally focused on the first-time home buyer type process. And we wanted to dip into a little more of the on the investor side. And
do you have something new to add? Because I just did that exactly.
Yeah. Well, what's new to add, which you omitted from your intro,
Thanks.
Was that we were focusing on the investor side. So these were clients that had wanted to get into the investment game, were relatively unsophisticated in terms of owning multiple units and that type of thing. So they were newbies in that sense, and so we wanted to try to dive in through some of that process and some of the hurdles that came up along the way, and that we were able to sort of put fires out along the way and get the deal done at the end
Triumphantly.
Triumphantly. Yeah. So
Nice. Just
I guess
before we get there, Steve, are you still in a band?
Yeah, I still play. I play in a cover band now, though, because
Okay.
you can't make original music anymore. It's not allowed. So yeah, can't do that. So I play in a yacht rock cover band, sort of Doobie Brothers and that kind of stuff.
Nice.
So with some familiar faces, people that you guys know.
Would know, yeah.
Billy Holmes.
Nice.
Okay, nice.
Yeah, Andy Richardson.
Nice.
Yeah,
cool.
Hamilton connection.
I was
Nice.
actually looking through my record collection, and I have one of your records.
One of my records.
I went to the Hamilton Philharmonic Orchestra.
What?
It was
Look, Twin
this.
Within.
It was that?
Twin Within.
Yeah, exactly.
That's so fun.
That was at the church on McNabb.
Yeah, New Vision.
Yeah, that was very cool.
That's crazy. Yeah, you and 300 people. That's it.
Nice. That's right. Okay, so we, in order to jump in, kind of, maybe Josh, you'll talk to us a little bit about the profile of the client, how they came to you, what they were looking for, and then we'll kind of launch from there.
Yeah, so these guys were they're past clients of mine. I had sold them their primary residence that they're living in. They live in the West End off Lock Street area, and they had, as an investment strategy as a family, they had put some money in the markets ahead of the 2022 sort of decline, and they were really taking a beating on some of their investments in financial markets, and so they had come to me with the idea of trying to move their money into a rental property instead, which obviously I feel like is a great move these days, especially given sort of where the market has come down to with price declines over the previous maybe 18 months or so from now. And so, they reached out to me and they wanted to talk about, who might be good to set up the financing for them. And so we got Steve in touch and started working on pre-approval there. And then from there, we started looking at, started just trying to get their feet wet, generally looking at 2 units. It's tough to really get a property to cash flow if it's just a single family. So we were looking at duplexes. They were somewhat limited in the budget. So we were looking initially like under 600, and then we ended up pushing that a little bit. But generally around that price point. And after seeing a handful of properties in that sort of entry level price point, there's frequently work required in a house. And the client there, Dan, was very open about not being very handy, not being overly interested in having to do many renovations. And so they were primarily focused on something that was a little closer to being turnkey.
So that's a tough assignment.
Which was a tough assignment at that price point, particularly. So we were looking in all areas, both within Hamilton and sort of outskirts as well. But they looked at a few other options. There was like the student rental in Westdale that was sort of pushing the price point, but was like a dog's breath in terms of condition of the property compared to what they ended up with. So we ended up with something down near the stadium that had been renovated by a contractor that the seller was actually trying to flip the property. And so that's the property we ended up with. And the story there, the history on the property was the fellow that had bought it was, unfortunately, they had bought it right at the peak of the market in February of 2022. I think the numbers on it were, it was listed for like $299. It was in really rough shape at the time, listed for $299. These guys bought it for like $480, so significantly over asking. And then shortly thereafter, the market started to tumble with interest rate hikes and such. And so they had been sitting on it for quite some time. They had completed the renovation. They had initially relisted the property at $750, which, if things had sort of progressed along the same trajectory they were based on February 2022, they might have been able to fetch something in that range, but it was just sitting there with no action at that price. They dropped it $7.25, $699, $679, $650, and then that's when we finally went after it, and we were able to secure the property just over 600,000. So yeah, that's kind of the general the overview of sort of how things progressed on my side of things. But yeah, we wanted to get into some of the nitty gritty, particularly on Steve's side of things, on the financing side. Some of the things we ran into along the way and just trying to get the deal done. Maybe you could speak to some of that, Steve. So I got the offer accepted and sent it off to you, and then you ran with it.
Well, and first you probably would have asked, can we do a condition of finance? Do we need a condition of financing? And we said that there was a square footage issue, or I anticipated that the square footage was going to be something that we had to work around.
That's right. Actually, we did talk about the particular property. I think even before the offer went in, right? Yeah. There was a quick back and forth, and yeah. So
can we? Because usually, people are asking, can I go infirm, or do I need a condition? This one, certainly the clients were fine to borrow the money. It really came down to the property, and so we did our 5 business day condition of financing. Found 2 lenders who were willing to do it at that square footage. It was below 750. 750 is kind of the rental property minimum for most lenders. They want it to be a certain size because they're afraid of marketability in the future. It's like if especially as a rental, if it's a rental and you get a crummy tenant and there's a problem with the tenant, they destroy the property, then the landlord stops paying the mortgage. Well, now the lender is holding the bag and they don't really want that kind of property. So, but this property, it was below 750, but it had a full basement suite that was the strength of the deal. Basically, that secondary living space was another, 600 to 700 square feet. So it was basically a 13 or 1400 square foot property, really. Mm-hmm. That's how we sold the deal to the lenders, and they said yes. And so then we did get a conditional approval for this one from 2 different lenders. And the reason why we did that is because we were also working through a crazy interest rate environment where some lenders were offering 1% higher than others. Like usually they're competing at 5 basis points, 10 basis points, but we were like, one bank's up here and the other one's down there. So, but then we had our second issue that we ran into, which was we did need to get an appraisal done. Square footage was fine. The rents that we were using were fine. The strength of the rents was pretty good. Market rents looked pretty good. But then our first appraiser came back with a substantially lower value, which was frustrating for the clients because they're sort of looking at the property and saying, this place is clearly worth what we're buying it for, and the seller, frustrating for the seller if they had only known, we're trying to sell this place for 750. Like you can't tell me it's worth way less than the low price that we sold it for already. And that was just, as it turns out, some lenders are, they want to control the whole process. They don't like the idea that somebody could persuade an appraiser to. And
so what you're describing is one of the conditions that the lender puts on is that an appraiser provide a sort of a third party assessment of the value of the property. How does that? And we'll look at the numbers in this deal. So it was 712. 612, sorry. And the appraisal, and so there is a value to loan ratio that they're looking at.
Yeah.
And so that, and conversely, that the client, the buyer, is counting on in terms of financing the deal. So they say we've got X amount, we are counting on say 60% to be funded from the lender. And how does that work in terms of, well, let's start at how much were they looking to receive from the lender?
So we wanted to go all the way up to the max, which is 80%. So 80% means you're not bringing as much of your own investment capital to the table, especially if the cash flows well with the rents. And so one of the lenders was willing to do 80% of the appraised value. And that lender happened to be a bank, and they were the bank who ordered the appraisal report directly. So I wasn't involved in that. We didn't get to choose the appraiser. They delivered the report, and that was the one that came in substantially lower than the purchase price.
And it happened to be an appraiser based out of
Niagara
as well, not based out of Hamilton.
Totally, just a randomly assigned person. This is an issue with appraisals in general, is that they're not all equal. You would expect that they would be using scientific methods that are always going to be the same result, but there are biases built into the appraisal reports, and there's local knowledge which is missing. So we talked about local sort of specialists. Josh knows at this intersection this property is worth $50,000 more than at that intersection, but the appraiser from Niagara doesn't know that. So we basically got burned by that mechanism that the bank was using an appraiser that we didn't have any accountability to or from.
So it's the equation then becomes 80% of whatever the appraiser comes
value
into, rather than the 612 that they're counting on.
That's right. And in this instance, it was a deal killer because we didn't have enough money to cover that shortfall if we wanted to proceed. So the rate would have been better. We were happy to go ahead with the conditional approval that we got. We wanted that, but with this lower appraisal report, we were stuck. And because we have with conditional offers, the seller does expect you to firm up at some point. They want you to do it within that window. It's hard to ask for an extension, but in this case, I believe we did go back.
Get an extension, yeah.
That was
after that first, I think that's what happened, was after the first appraisal came in, it was low, and you sent it off to the second lender, and you were able to order your own appraisal for that one, I believe. But that second appraisal was going to take some time, and we were right on the bubble of the end of our condition period. So I think we bumped it into the next week by a few days. Nothing crazy, but you're right. Sometimes a bit of tricky with sellers if they're not on board with pushing deadlines.
Sure. This is a great example of the why for the mortgage agent. I've got some clients. Sometimes they are asking for insight into what the benefits are of having an actual mortgage agent versus going to the bank and speaking to a mortgage specialist at any given bank. The clearest example is, the mortgage agent is looking to different lenders. They've got several different criteria, and there's flexibility there. But when you come into an issue like this one, it couldn't be more obvious that having a mortgage agent that is familiar with appraisers, familiar with the process, you have a lot more flexibility and a lot more options at your disposal in terms of keeping deals alive.
That's right. Well, problem solving. It's like, this didn't work, let's do that. Well, that didn't work, let's do that. And you have a plan from the beginning, plan A and B and C and so forth, so that you can make sure that it happens. So especially these days, somebody gets an offer accepted. Yeah. Like we got to work on it. It's not a lot of transactions out there right now. So yeah. Well, and then in this case, if I had my druthers, I would have chosen the appraiser up front from the beginning, because I knew with the square footage that it was going to be maybe an issue anyway. But we had to make a choice. Oftentimes we do make a choice based on what the cheapest option is. Let's go with this one. The rate's lower. We can borrow more money. Now, and also with a mortgage broker, to your point, like we have relationships that we can lean in on. So if I have a problem, then I can call a bank or a lender like First National, CMLS, MCAP, whatever, and say, hey, Joe, can you help me with this? And with a bank, you can't really do that. I mean, you're sort of, it's a giant corporate structure. If they allowed people to do that, everyone would do it all the time, and it would just destroy their business model. So whereas on the broker channel, we can ask, a First National Financial, I've got this deal conditional on financing in 2 days, and I'm going to get an appraisal done. Can you review this file right away? And same with instructions. We'll get to that too. Dealing with a bank, maybe it's like, can I get this instructed? It's like, just no. But then
you
some
can
lenders
12 days from now.
Some lenders, it's like, can I have this instructed today? And they're like, yes, click. So anyway.
So we get, in terms of the appraisal, initial appraisal comes back, not as encouraging as what you're looking for. What happens next?
Well, there's, you talk to the clients about it first, because you have to talk about, what is this place actually worth? Is the appraiser right? Right.
It creates a bit of fear in the customers in the back of their mind. Like, wow, is it really only worth that much? Like, am I overpaying for it? And so we went back and we were able to send some other comparables for them as well, right? To help beef up that appraisal report.
I usually kick it in a situation like that, which has happened more often than, not recently. I usually say, like, to the realtor, what have you got to fight this appraisal report, or what can you use? What was your rationale for the value? And then at that point, we pass that along to the appraiser. And usually, if they're a good appraiser, they're going to they'll own up to their mistake, or maybe not mistake, but they'll change their mind.
Yeah. So then, Steve, can you try to recap for us then? So we had the first appraisal came in. When it came in at $550, I think it was, our purchase price was $612. That first appraisal, I think, they ended up revising. They came up a little bit for us, but in the meantime, the second appraisal came back and gave us the value.
Yeah.
But then the terms of that mortgage were different as well. Anyway.
That's right. So in that situation, I had to try to keep the lower rate with the bank. I wanted to get that deal done. So you and I worked on comparable sales to try to encourage that appraisal report up. Yeah. But we had our condition of financing as well. We had to firm up. That was a dead deal unless the appraiser was going to listen to us, which takes time. Mm-hmm. So I did pursue a second course. Can we get an approval from this lender? And they were willing to do it not to the full 80%. They were only doing 75%. Some lenders do have a 75% cap for rental properties if there's an exception. So if square footage is a problem or income's a problem, then they're going to say, okay, well, we'll do it, but we want you to bring a little bit extra. Yeah. And we happen to have enough money to do that deal if the appraisal report was on target for that one. And because we were able to choose the appraiser for that one, I was able to say, here's the situation. Here's why we think it's worth $612. And then they were able to deliver, and that meant that we could mechanically, we were able to waive the condition of financing and then decide afterwards, can we make this work on the lower interest rate side with less down payment? And that's certainly what the clients wanted. Yeah. They didn't want to bring more money at a slightly higher, the rate was like 0.02% higher. It was like not substantial, but it was, there was a better deal over here, but the appraisal was a problem. And eventually that appraiser did come back. He bumped it up, but when you did the numbers, it was still worse than what we were dealing with on the new deal. And the lender that we were dealing with, their response time was so slow during all of this. We didn't have a long runway. It was like maybe a 30, 40 day close.
I think it was about a 40-day close. Yeah.
So we didn't have tons of time because we had to get the lawyer instructed at some point so then they can do their job. And there was some danger that the first bank that we worked with, who had the crummy appraisal report, that they were going to take too long to figure out how they felt about all this, because they have to not only, once they get the new appraisal report, that doesn't mean they're going to accept the second appraisal report. They have to consider what's going on here. Like, why was the initial appraisal report so low? And now it's up. Like, did this broker strong arm that appraiser into going up higher? Like, so there was some consideration time. They had to mull that over. Yeah. While they're mulling that over, the deal is pending. It's not approved yet. It's still just sitting there. So we didn't actually have a deal with that lender. We didn't find out our actual approval for that until 5 business days before closing, which is nearly impossible for us to do when we're passing the file over to the lawyer to finish everything off. 5 business days, you would have been instructed at basically the last second. If there were any problems, now you're in the hot seat to try to make it happen. Maybe you have to kick it down the road or whatever.
Well, you'd be surprised how often that happens. 5 days at this point seems like plenty of grace time.
That's not good. That's not good business, but yeah.
Yeah, absolutely. Okay.
Yeah. So passing it back to you guys. So once we had resolved that appraisal issue, once we had the clients satisfied with, okay, we're going to bring this much money down and whatever, we came up with some other stuff behind the scenes that's not really part of this conversation. How do we come up with this extra money? What are we going to do to optimize everything else? Because not everything is just one item. It's all connected to their financial landscape. And so we found a solution. All right, we're good to go. We met all the conditions, and then that was it, basically, from my side.
I see. Yeah, you were trying to pass that off. Yeah, I'm picking up now.
Yeah.
So at that point, we're instructed. We get the file going. We acknowledge the receipt. We've got the agreement of purchase and sale in hand. We've got the mortgage instructions in hand. One particular aspect about this was that we then needed to be re-instructed. Can you talk about that?
So sometimes when we're dealing with a file, some banks, for instance, like Scotiabank, they don't even issue an approval until all the conditions are satisfied. There's no moving forward.
So that's the difference between broker complete, and then once broker complete is that criteria is met, that means that the broker has satisfied everything that the lender is looking to receive. And then the instructions that are produced, those are really just a list of things that's the lawyer's homework. So the solicitor's instructions, lawyer's instructions, that's the bank telling us, here's a checklist of everything we need in order to fund. And so those are those solicitor instructions. Once it's broker complete and then solicitor complete, meaning we've checked off all those boxes, we've met with the client, we've sent back all of those signed documents that they were looking for, we've verified ID, then we send that back to the bank. The bank says, okay, we are solicitor complete. Then all they're looking for is a document called a request for funds, which means, can you please send over the big bag of cash so that we can close this deal? Mm-hmm. And so we received it, and we've opened the file, and then at a certain point we received a second set of instructions. Pivot on that, I think the issue was a very minor change in the actual purchase price over the course of the file. And then at that point, we put together all of the documentation. We met with the clients, and that was a few days before closing. Sign up all these documents, and we turn around, we send that to the lender. The lender says, okay, we are solicitor complete. We also send documents out to the seller's lawyer, and there's communication there. And then once that is done, we are just sort of waiting for the closing day. One of the things we talk about with the client when we meet is not only the implication of each of the documents that we're having them sign, but also we're looking at the balance sheet for the transaction. Mm-hmm. One of the key documents is called the statement of adjustments, which is really everything that happens after the agreement of purchase and sale is signed. So you can imagine agreement of purchase and sale is signed, a deposit is put down, and so we adjust for that in terms of what we are sending over to the other lawyer to close the deal. Realty tax is often adjusted for. In this case, it's a rental property, so rental income for that month would be adjusted for. And then it's really just a left-hand column of things that are subtracted, added, and then we tell the client, this is what we need to send over to the other lawyer. Then we have another document, which is kind of our internal ledger. And it says, here is the amount of money we need to send to the other lawyer. Here are the land transfer tax. Here is title insurance. Here are our fees. We add all of that up. We know that the lender is going to provide X, and so we're looking to the client to provide the balance. And so we give them instructions on how to get those funds into our trust account, so that on the day of closing, we've got those funds in the trust account. All we're waiting for are the funds from the lender to land into the trust account. And at that point, kind of the wheels are in motion. We send that off to the seller's lawyer. Seller's lawyer acknowledges receipt, and then we're effectively closed up. Mm-hmm. Yeah.
One thing that's excluded from that process for this deal is this place was vacant, right? And so I wonder if you could speak to, Santi, just the dealing with rental properties as the lawyer. I find that the realtor and the broker can do their best to try to set everything up, but there are many legal issues surrounding landlord-tenant board stuff with I'm buying this rental property or notice to vacate, all of that kind of stuff. This case, we didn't have to worry about that because it was a vacant property. That was part of the marketability of the property, honestly, knowing that you could get your own tenants in at market rates instead of whatever the rates were of the day. So typically, how does that work when you're dealing with, it's an existing tenant or there are two units that are tenanted?
So to preface that, the usual circumstances is that a property that's bought or sold is delivered vacant, full stop. In certain instances, when you've got a rental property with the expectation is that it's going to be revenue generating. The other condition is there a tenant or is there not a tenant, as you've alluded. And then the other consideration, and this is really a consideration that comes into play when the realtor's kind of looking at it, is does the client wish to sort of take over the existing tenants? And the real issue arises when the answer is no, and there's an existing lease in place. And that is a very problematic kind of set of circumstances. And really that falls to either the seller or the buyer, depending on how the agreement of purchase and sale is set up. So if the expectation is that it be vacant, then notice needs to be provided to the tenant. The closing date needs to be adjusted to reflect the time that they need to vacate. And then in very few circumstances do we get to a point where all of that's done, and that notwithstanding, everything done properly notwithstanding, the tenant refuses to vacate. And then you're in a position where it's, do we close? Do we dig our heels in? Do we take this, the presence of the tenant and the absence of sort of vacant possession as a breach? And these are issues that are certainly they're big hurdles. They're to my mind one of the most significant problems that can arise on closing. And at that point, really, there are decisions that need to be made as to how to deal with that. But that's a part of a broader and very complicated conversation. But it really brings to my mind the importance of a realtor who is in tune with these issues. And not only that, but practically speaking, how long does it take to, in the best of circumstances, get a property that is vacant? If there's a tenant in place, then there are sort of the human aspect of it, and that is that there's a tenant, they have motivations, and they have interests that may not be aligned with selling the property and finding a new property. And so these things need to be handled, with empathy but with an eye towards what is a closing date and how do we structure this deal properly.
And when that, I guess, working backwards, you're talking about the problems that are created basically by not doing all that work up front at the very beginning. The realtor is effectively the quarterback for that, trying to figure out, is this tenant?
Can we even get vacant possession?
Yeah.
Are they willing to vacate? Can we get an N4 signed, or whatever the case might be? If the buyer is actually going to be living in the property in one of the units for their own purpose, it's one way you can vacate a tenant. But and the lender might have issue, for instance, if the deal is approved based on the buyer occupying one of the units. And then at closing, we have to assume the tenant. Well, the lender might not accept that.
No, it's a rental property now.
Yeah.
Or it's a owner occupied is a different rate structure then.
Yeah.
Right?
Yeah,
Sure.
exactly. So all of those things can play into the nuance of the deal.
But in this case, we didn't have any of those problems.
Yeah, no, it worked out well. Vacant property, and it worked out. Actually, that's one of the things one of the other things we were able to get into that deal was that. After our condition period, once we had a firm transaction pending closing, I had inserted a clause that allowed for us to be able to show the property to prospective tenants prior to closing. So we were able to then create an ad for rent. I can't even remember if they did Facebook or if they did Kijiji or what they did, but we were able to advertise the place for rent using the photos from the MLS based on permission from the seller and the listing agent. We had a slew of tenant inquiries. We held a couple of little mini open houses for tenants. This is all prior to the deal closing. And so that way we were able to actually have a tenant lined up for the day of closing, or I think just a couple days after closing. I think we closed May 26th or 27th or something, and they had a tenant lined up for June 1st. So it worked out really well that way.
And Steve, from your perspective, when you're putting together the mortgage application, the art is really in putting together this narrative that's going to persuade essentially a lender that this is a viable investment. So is there a distinction between a property that has these tenants in, that has a 2-year track record of being revenue generating? Does a lender look at that differently than if you just put together a business case, assuming there are lenders at this rate?
Yeah, so that's a good point. So there are 2 different ways to determine rents from the lender side. There's the actual rents, which would be what you're describing. You know, we've got a case here. Here's the lease agreement, and we can see that this has been a strong, you know, cash flow positive thing, especially if they've owned the property before. On a purchase, you know, we'll take the lease agreement to prove what the rents are right now, or we'll do market rents. And lenders don't like market rents if they can avoid it. You know, market rents are wishy-washy, and there's no guarantee you're going to get those rents. So in the case of this particular deal, part of the 75% that we were able to borrow, that was tied to the fact that we were doing market rents. You know, that it's not the only reason why it was 75% instead of 80, but that lender, with all of those other factors combined, said, well, and we're doing market rents, so okay, well, we'll only do 75% on this one to eliminate some of their risk. Yeah. So most of the time, if we can get, you know, buying a place vacant, if we can get a tenant lined up, great. But it's very difficult to do what Josh just described. I mean, like that's a big win. You convinced the seller, like, we don't even own this place yet, but I want to shop it. Yeah. They understood what the place was for anyway. That's how they sold it. Yeah. But to get a tenant lined up for June 1st, when you've got a May 26th closing, like usually there's at least another month lag before you get somebody in there. And to get that person to commit to a July 1st tenancy in April is also just super rare. Like, who's going to sign that? They're looking for a place right now. Like, I'm looking for a place to move into today. So we do often have to work around the market rents, and that limits the borrowing power when we're dealing with certain banks. I find in general, if you were to delineate between sort of banks versus broker channel lenders, you know, your banks are Scotia, BMO. BMO's in the broker channel now, by the way. They just joined back into the broker channel. Okay. So Scotia, BMO, TD, and then like smaller banks like National Bank or Laurentian Bank, they are more market rent friendly. And so in my rental portfolio, all the clients that I work with, we're doing a ton of bank deals because the market rents are the easiest way to do it. The rates are typically competitive, if not lower, and the terms might even be flexible for down payment, stuff like that. On the other side, First National, CMLS, MCAP, you know, RFA, any of those broker channel lenders, and the credit unions too, Meridian, Alterna, any sort of that style of lender, they really don't like risk. They're the type of lenders who they're in the business of eliminating risk, so then they can go back to their investors and say, look how great our portfolio is. It's AAA, not AA. We're a single A. The banks are single A. Those guys are AAA. So their market rents are kind of a dirty word, you know, for those lenders.
Wow. Okay, cool.
So.
Okay, and then the rest of the deal went off without a hitch.
Yeah, the lawyer
once it got to your desk.
Once it got to the lawyer, it was great.
Yeah, after we did all the work.
That's right. Teed it up. And then we were able to get it closed up. They are in, and
happy in the tenants. In fact, actually, a fun little tidbit. I was just driving by that area the other day, and the property had a nice like front porch on it, and the new tenant had like all these nice drapery on the front porch and hanging plants and flowers and stuff. Looked really nice, like the kind of way you'd like to see your property looked after by a tenant.
Nice. This should segue into like tea out on the veranda with the tenant.
Yeah.
And then, but yeah, we'll see if we can get our client and mutual friend to maybe pop in and sort of pump our tires. And
put some faces to
that's
names
right,
or lack there.
but yeah, wonderful. This has been kind of a dissection of the transaction, and hopefully we get to do a lot more. What I'm talking about when there's a benefit in sort of the integrated team is kind of amplified in this instance, because we're able to we know each other, and we've known each other for a long time, so we're able to sit down and kind of pull that apart, and then hopefully even just get insight from the clients as well. So that's kind of a rare scenario, and one that we thought would provide a little bit more insight that isn't commonplace. And so hopefully that's been helpful for everybody. And yeah, thanks guys.
All right, thanks for having us.
Nice. It's your podcast.
All right. Thanks for being here.
Yeah. Thanks for having me on
our
Baywatch.
podcast.
Nice. I feel a lot of pressure to like say funny things, and I resist that.
Yeah, you really put me on the spot
I know,
on the intro.
and
there.
that's
I was
and that's where I was.
Wow,
going
I'm like
next.
a deer in headlights.
No.
Do I get aggressive? Do I try to be funny in return?
And it's not fair
like, do you wanna
because
fight?
yeah, it's like low hanging fruit, and you tend to be like, obviously I'm going to go to the butt of the joke, like I'm going to talk about those shoes or something like that, and I think that's unfair on you. You know.
Those shoes are great. You guys both have great shoes.
Thank you.
I quite like my shoes.
You look
Thank
like
you
you're
for pointing
in
out
like
my
a
shoes.
punk ska band. Like, it's gonna get real loud. There's gonna be trumpets.
Yeah, something like that.
Yeah, nice. The trumpets are good.
Yeah, sure. Yeah, well, trumpeting our success on this deal.
Oh, love
Bada
it.
bang.
Love it. It is your podcast.
On that note, I'm out.
Right on.
Yeah.
Awesome. Thanks, guys.
Okay, we're good.